Welcome back to the Financial Freedom Show. My name is Rob Berger. Today's episode, we're going to look at GameStop. It's been all over the news over the last couple of days and weeks. I'm going to walk through exactly what's happening to cause this stock to go to the moon. The price volatility is just unbelievable. And we're going to look at what's going on. Why did it happen? Is this a good investment? Should we jump on this train that seems to be headed to the moon? Or should we actually be, scared to death? I actually believe that once the current market, not just GameStop, but once the current bull market ends, and it's going to end at some point in a big way, and the history books are written on this, GameStop will be a complete chapter in and of itself. So enough chit chat. Let's get right to it. First, I'm showing you GameStop's current price. Now you can see it closed yesterday at $147.98. It was only up 92% yesterday. So there you go. And that's the green line. The gray line is what's been going on after hours. And so it's actually gone sky high again. You can see pre-market here in small print. It's now at $219. So in other words, while most of us were sleeping, GameStop's stock went up. It's up now. It's going up even as I record this video. It's up 49% from yesterday's close. So it's currently sitting at 221. Now it's 220.97. So the stock is just, it's completely divorced right from fundamentals. The people trading GameStop are not analyzing the income statement and the balance sheet and trying to understand what this company is worth, right? There's absolutely no fundamental analysis of the company itself happening at all. We're going to actually do a little bit of that today. This is primarily in the options market. That's where the action really is. Folks buying calls and market makers having to buy the stock as part of that transaction. And that's really kind of what's going on, which makes, by the way, this Friday a very interesting day for GameStop stock, in my opinion. We'll get to all of that in just a minute. But let's pop over here to a Wall Street Journal article so to kind of understand what happened. So GameStop has been struggling like all retailers. We'll look at its financials in a minute. But 2019, for example, was terrible for the company. The first three quarters of 2020, and its year end ends in February of each year. But the last three quarters have been terrible. And so the current frenzy of buying occurred or started to occur earlier in January when the company, and you can see it right here, they announced that co-founder of Chewy's, Ryan Cohen, and two of his colleagues had been added to the board. Now, at that point, now this is just January 13th. You see here the GameStop shares were up 57% to $31.40 on Wednesday. That was just 2 weeks ago, and now it's over 200. But this addition of Ryan Cohen to the board sort of sparked an increase in the price. And what was happening at this point was, as the price was going up, there were some big investors that were shorting the stock. In other words, they were betting that the stock would go down. They're effectively borrowing stock today and hoping to sort of repay the loan with cheaper stock tomorrow, right? Well, at the same time they were doing this, there was a group on Reddit that you may have heard of called WallStreetBets. And it's kind of a wild place if you ever go there. Actually, it's hard to get this thing to load. It took me 5 minutes to actually get into this subreddit today. And there's just a lot of craziness going on with GameStop. I can assure you, at least from what I've seen, there's no fundamental analysis going on here. This is a group of investors many of them have made a fortune on GameStop. Good for them. And they're wanting to keep the party going, right? So there was this sort of us versus them. It was sort of the renegade day traders, momentum traders on this subreddit versus the big hedge fund investors, the big Wall Street guys trying to short the stock. And what happened was, as the price of the stock kept going up, those that had shorted it kept losing more and more money. They eventually bailed. They eventually closed their positions. They said, look, I don't want to lose any more money on this. Every day the price goes up even more. I'm losing more and more money. And so, of course, the renegade, I call them renegade traders. I think, it's kind of fun to watch all of this. The renegade traders are like, yes, a victory for the small guy. And, I think this posting here kind of, I think, tells you all you need to know. Don't effing sell. We like the stock. Hold the line. I mean, this isn't just about a stock or even making money. I mean, this is sort of like a battle of the little guy versus, the big hedge funds on Wall Street. And so that's what's happening. You can check out this subreddit. Again, it's WallStreetBets. There's also, as you can see here, a Twitter account. So you can follow this if you're at all interested. And so when I saw all of this, I thought, well, what's going on with actually the company? I mean, I know that it doesn't seem like anyone really cares in all of this craziness. What's actually happening with GameStop, the company? So I decided, well, I'm going to take a look. And so the first thing I did, and this is what I do whenever I evaluate a company, is I pull up their last annual report, their last 10K. And again, this would have been filed, as you can see, the date of the audit opinion by Deloitte, March 27th, 2020, so a little under a year ago. And first I go to the balance sheet. And again, this was at a high level. I do a couple of quick things when I look at a balance sheet, and this one actually doesn't look awful. The first thing I do is I look at total current assets and total current liabilities. You can see total current assets are right here. And for February of 2020, they had 1.6, this is in millions, so 1.6 billion in total current assets. Current assets are just cash and other assets that they expect to convert to cash in the next 12 months, right? So that's what a current asset is. And then I compare it to their current liabilities, which are down here. Current liabilities are those debts that are payable in the next 12 months. And you can see their current assets, 1.6, their current liabilities, 1.2, and that's good, right? You want current assets to be at least as much or more, and preferably a lot more, than current liabilities. They actually call that a current ratio, and you want it above 1, and in this case it is. And the idea there is simply, can the company pay their debts over the next year? And if their total current assets are significantly below their current liabilities, that could be an indicator they're going to have some trouble paying their bills. And so that's a bad thing. But here, no, their current assets are above their current liabilities. That's good. And I look at their debt, and they certainly have debt. You can see they've got $500 million, $419 million in long-term debt, and they have another $529 million in operating lease liabilities, which I view as debt. And so they've got $1 billion in debt. So this company's got a lot of debt. And so that's certainly a concern. But it does look like they're going to be able to pay their bills, and so that's good. So then the next thing I go to is their income statement, consolidated statement of operations. Are they making money? That's just, that's the first thing. And what are their margins and things like that? And you can see they're hemorrhaging money, actually. I mean, they made $34 million in 2017. Actually, that's actually a concern for me. The concern is that their sales were $8.5 billion. They could only squeeze $34 million out of that. That's not a great company. And in 2018, they obviously just, the dam gave way. They lost $673 million. They improved a little bit, I suppose, in 2019, but still losing almost $500 million, $470 million. So to the extent that anyone actually cares about the financials of this company, it's struggling. And in fact, if you go to their cash flow statement, which is, there's equity, there we go. We can see that cash flows from operating activities. That is, do they have positive cash flow from conducting the business that they're in, selling video games and video consoles and the like? And at least in their most recent year, no. Their operations, just by opening their doors, they lost $400 million. Now, that was in 2019. Obviously, their cash flows in 17 and 18 were positive. That's good. So who knows? Maybe 2019 was just an aberration, maybe it's a bad year. So after again, this is sort of a very high level on the financials, but then I go to their most recent quarter, and again, they have somewhat of an unusual fiscal year end, so you can see 13 weeks ended and 39 weeks ended, basically their last quarter and then the last 3 quarters. And here, let's first go to their balance sheet, which is right here. And you kind of see similar, right? They've still got current assets that exceed current liabilities, not by as much though. So it's not moving in the direction that I would like it to see. Their long-term debt has gone down a bit, so that's actually good news. And maybe they've paid some of it off. That could perhaps explain why their current ratios is decreased a bit. I don't know, but that's the balance sheet. I don't even think we need to worry more about it, because when we look at their statement of operations, they're still losing money. Now, maybe not as much if you look at the first 3 quarters of the fiscal year. If you compare it to 2019, you can see here 2019 in the first 3 quarters they lost $491 million. That's come down. They've only lost $295 million so far this fiscal year. But what that means is this company's losing money, right? It's hemorrhaging money. Its current market cap, based on the latest flurry, if we go back here, their market cap yesterday was, as you can see, 10 billion. But assuming this holds, it's now at 217. Assuming that holds until the market opens, this is going to jump up to, I don't know, 14, 15 billion overnight. All right. So the takeaway is that what's happening to the stock is just insanity, right? It has absolutely nothing to do with the value of the company. And I would guess, I don't know, I'm not part of WallStreetBets, but I would guess the folks in there, they know full well that they're not. I don't think they've convinced themselves that the company is actually worth 10 billion or 14 or 15 billion. They're riding a wave. That's what they're doing. And the question becomes then, well, what do insiders think about all of this? Are the officers and directors of the company? I mean, are they obviously they're watching this, but I mean, are they just going about their business, selling video games, or how is this affecting the company? So one of the things I like to look at is what's called a Form 4. It's something that an officer, a director, an insider has to file with the SEC if they either acquire shares of the company or sell shares of the company. And so the most recent ones that I can find were here January 19th, which, in normal times, that would be great. That's not that long ago, except given what's happened with the stock, it's like that the 19th almost seems like ages ago. In any event, let's take a look at this first one, and I'll make it a little bigger for you. So here we got someone, they're a director. We can see that here. And what did they do? Oh, they disposed of stock. Now, it's funny. Well, they probably don't think it's funny. Look at the price they sold it for, $38. They probably wish they'd held it for a week. But they got rid of 3,500 shares. So even let's think about that. At we'll call it $38, this director who let's assume knows the company a lot better than you and I do, was out. 3,500 shares, I'm gone. Now that's maybe not a ton of shares, but they were out. So how about this one? Make it a little bigger. Another director. This time, look, the D here tells you they disposed of the shares. They got rid of 50,000 shares. Again, look at the prices. They're probably kicking themselves. But again, here's someone that even at $30 said, this is ridiculous. I'm out. 50,000 shares disposed of. Let's see. We'll look at a couple more. Maybe we'll find someone who believes in this company and is buying. Another director. Nope, they disposed of 5,000 shares at $31. How about this one? Does anyone believe in this company? A director, look at that. Sold them all. 14,000, 74, 35, 91. And again, prices at $40 and lower. Let's try one more. There we go. We found someone who's going to acquire it. Ryan Cohen. He went on the board. Look, he's done extremely well for himself. Of course, that's assuming he sold today, right? Who knows how he'll do long term. There you go. That makes sense. He acquired it, and in part, that sort of triggered this flurry of activity. Of course, he acquired it $14, $15, and $16. I'm not sure he's going to be a buyer at $220. Maybe he will be. I don't know. All right. So having said all of that, what does it mean? Well, first of all, as an investor, of course, I'm not going to touch this with a 10-foot pole. This will not end well. It will end very well for some people, particularly those that got in early. There have already been reports that people have made 10 million or more on options on this company. Whether that's true or not, I don't know, but just from the numbers, it certainly makes sense. But this is, of course, obviously not a long-term investment. This is a day trader momentum play. And I will promise you this, a lot of people will get hurt badly when this comes to an end. The question is, when will it end? In economics, they say, predict what or when, but not both. But I'm gonna predict that this Friday, there could be a lot of action in this stock and perhaps a downward move. Why? Well, it's because there's some options that are closing out, expiring. I'm looking at the call options for GameStop. This is on Yahoo Finance. These are calls that expire January 29th, so that's in 2 days. And it's fascinating if you go look at some of these prices. I mean, for a call option, let's go back and remember the stock's trading. It closed at 148. It's currently at 213 and after hours, but it closed at 148. So options with a strike of 150 that expire in 2 days are selling for 31.20 a share. Of course, given the after-hour markets, this doesn't make much sense. As soon as the market opens, these numbers are going to change dramatically. But you've got a lot of calls that are expiring in 2 days, and so I think we could see a lot of action. Well, we're going to see a lot of action in this stock today, tomorrow, and Friday. But I think we'll see. I think the party could come to an end for a lot of people this week. I could be wrong, and I'll be the first one to acknowledge it. If I am, as a fundamental buy and hold, get rich slowly investor, I'm not touching GameStop stock. If you are, maybe you think it's the greatest thing in the world, leave a comment below. I'm happy to hear all perspectives. Let's just stay friendly about it. Keep the language kind of clean if you don't mind. That'd be great. Hey, till next time, remember, the best thing money can buy. I don't think it's GameStop. I think it's financial freedom.